It is time to start our presentation of Cramo plc, and now it's time for our first interim report Q1 in 2015. Welcome here, all of you, and also those who are following this presentation from the web. I'm the CEO of the company, and later on you will see on the stage also our CFO Martti Ala-Härkönen. The content of the presentation is very much the standard, so we will give highlights of our fresh report of this morning, and afterwards hopefully we will have a good time for your questions from here audience and also from the web. First of all, it's good to start by stating that the start of the year has been, I would say, promising for Cramo. So this means that in a seasonally weak first quarter, our sales grew and results improved quite clearly compared to last year's first quarter. This positive development started already in the autumn last year, and thanks also to both our own improvement actions and the improved market situations which have been continuing during first quarter comparing to last year first quarter. So in sales, this means that if we count in local currencies, our sales growth was 8.6% for the group. Sales was developing in all segments except Norway and Denmark, where the sales was not increasing, mainly because of our actions made last year to focus the business in certain parts, which we will comment later on more. It's good to see that especially we have realized good development in sales in Sweden, which was expected based on the good start of growth late last year. As well as some countries in Eastern and Central Europe. For example, Poland, Polish construction market is now started to grow quite strongly. Clear highlight in our report is modular space operations, where the sales growth in local currencies was 25.9%. We have now decided also to disclose financial information by product areas by quarter. Actually, we disclosed at the year end after last year Q4 the similar information, and now we have decided to continue this reporting by quarter, which means that later on we will disclose here financials separately for equipment rental and modular space rental. As we commented in the previous quarters last year, we have made several improvement actions, cost-saving actions, but also improvement actions regarding operations, regarding sales, etc. And especially those cost savings actions has been now also having impact during our first quarter, as we estimated also end of last year. This means that our fixed cost decreased by 2.1 million euros comparing to last year in first quarter. We will continue the actions wherever it is needed. Some of the actions are continuing, but a special attention we will pay now to direct cost improvement, which is impacting generally in the gross margins. Then we are talking about practically improvements in transportation, improvements in our processes within repair and maintenance, etc. So that is having a special attention at the moment. Our EBITDA margin improved in all business segments except Finland, where it was slightly lower than last year. Particularly strong profit development we saw in Sweden, and our Danish operations also turned into profit in the first quarter. In Norway, we managed to improve our profitability thanks to cost savings made last year, as I already commented a few moments ago. In Central Europe, on the other hand, we saw seasonally weak quarter as we expected, and the result still remained negative, but the fleet utilization rates are now improving year on year. So Martti will comment more in details about the results, but our EBITDA was now 10.1 million euros, so it's more than double compared to last year. And that means that the margin improved from 3.1% to 6.9%. Earnings per share was plus 9 cents instead of a small minus last year. And by this we keep our guidance unchanged. Then if we update some of the lead indicators for the business. First, again, economic sentiment overall in Europe. This is again the latest EU Commission sentiment outlook. So first of all, it looks quite clear that economic sentiment is above long-term average generally. And in our markets, specifically Sweden and Germany, are clearly above the long-term average. Poland, as I said, the construction is growing well, but the overall economic sentiment is close to long-term average, whereas continuously Finland is struggling in our economy, and we are in Finland clearly below the long-term average. On the other hand, I think that the general expectation also is that European Central Bank's monetary stimulus packages are having a positive impact when going forward in different economies. How this then reflects to construction confidence, no surprises, following very much what we have been reporting earlier. So overall construction confidence, the black curve here is close to long-term average, and actually it started to be there late last year in August. And again, the same countries having a high confidence index, and it's Sweden, Germany, and Poland, whereas then Finland and Denmark of our countries are then somewhat below a long-term average. So no surprises, and I think still what we can say from here is that it's seen also in our operations that those countries where we have a high confidence, they are also starting to perform. Then just to summarize or repeat actually, this is soon becoming old estimate. Maybe the main message here is continuously the same, that we see that the rental outlook, rental business outlooks is improving during this year, and with this view also continuing next year. So the best improvements are expected actually in Finland, but also clearly for Poland and Denmark. My comment here is that I would estimate that the Swedish outlook will improve from this estimate. So overall, I think that the fundamental market situation is now promising, and this of course we have to now carefully analyze going forward. So even though we have made now very strong first quarter, we have a cautious view when now going forward. So we have to see now that the markets are really continuously improving as it's expected now. And now I leave a word for Martti.
Yes, thank you, Vesa. Like Vesa already mentioned, the start of 2015 has been promising for Cramo. We have started to see operational leverage materializing in many of our markets, thanks also to our performance improvement actions completed last year. There were no non-recurring items recorded in the first quarter, and our results improved year on year on almost every front. So let us start looking more closely on our results and starting with sales. In the first quarter of 15, our sales amounted to 147.1 million euros versus 140.3 last year, and there's a year-on-year sales growth of 4.8%. What is more important here, however, is that in local currencies, our sales increased by 8.6%. So the Swedish krona and the Norwegian krona continue to adversely impact our euro-based sales. By business segments, sales developed favorably in all business segments except for Norway and Denmark, where operations were restructured last year. More specifically, in local currencies, sales grew in Finland by 5.8%, in Sweden by 12.2%, which I think is a very good growth, in Central Europe by 9.3%, and in Eastern Europe by 9.6%. A specific highlight is that by product area, the modular space business grew in the quarter in local currencies by 25.9%. Vesa will later comment more on the product area financials, but like he said, we have decided to publish now also quarterly financial information by product area. And finally, as we can see in this graph indicating by the yellow line, which is the sales growth percentage by quarter, we have to go back 3 years to the first quarter of 2012 before we had a better sales growth than that experience in the beginning of this year. So next, turning to EBITDA in the first quarter, our EBITDA amounted to 10.1 million versus 4.4 million last year. There's a year-on-year growth of 5.8 million. And the margin improved to 6.9% versus 3.1% last year. Like already said, based on the performance improvement actions completed last year, mainly within our Scandinavian and Central European operations, the group's fixed cost base continued to decrease in the first quarter versus the first quarter last year. And I think this is a good achievement considering that we have been also doing bolt-on acquisitions both last year and early this year, which for their part have of course increased our fixed cost base. Considering seasonal variation, that is that Q1 is seasonally typically the weakest quarter of the year due to the winter season. Considering that, Finland, Sweden, Norway and Denmark delivered and reported good results in the quarter. The result also improved in Eastern Europe, including our Russian-Ukrainian joint venture Fortrent. And in addition, there was an improvement also in Central Europe with fleet utilization rates improving, but the result was there still a loss due to the seasonal variation. In this slide, we can see more specifically the EBITDA bridge by the first quarter of 14 versus the first quarter of 2015. And the first observation probably here is that the bridges are all green, and that is that the group's absolute EBITDA has improved all across our business segments in the first quarter of this year. The second observation, what we are stating here, relates to the performance improvement actions completed, which have clearly contributed on the results. Third, one could also state that as I see that the operational leverage is starting and is now materializing in many of our markets. One could take a few examples here. Sweden, where the market is now in good stage and good phase. There is good growth, but we have been able to contain very well our cost base, so we need to see a nice improvement in our margin. The same for many markets in Eastern Europe. I would also like to specifically highlight Denmark, which has made a clear turn to profit in the first quarter. Our strategy in Denmark, it's what we call it's very much focused based. So we are concentrating now within the equipment rental on best performing products and regions services, and also very much in modular space. And this is bringing results. And finally, the results also achieved in Finland and Norway, where the market situation is still weak and or at least tough. I think the results achieved show that we are on the right track with the actions executed. In this slide, we can see the earnings per share diluted by quarter. And in the first quarter of 15, like we already mentioned, we made 9 cents versus minus 3 cents a year earlier. And like I said, there were no non-recurring items affecting the earnings per share. One could comment shortly on a few lines in the profit and loss statement below EBITDA, which have an effect as such on the earnings per share. Our amortization resulting from acquisitions and disposals was 2.1 million. That was 0.4 million less than a year ago. And also our net financial expenses were 3.1 million. That is 0.3 million less than a year ago. So on both of these lines, there's an improvement versus last year, improving also the earnings per share. And in the first quarter, our effective tax rate was 21.0%, which is also the best estimate for the full year for the group at this stage. Next, turning to return on equity. In this picture, we can see that the group's comparable return on equity before the effect of the non-recurring items from last year and was 9.6 at the end of the first quarter. And there's a clear improvement against the 8.3% recorded at the end of last year. And I would like to highlight that all efforts continue to reach the group's financial target level, which is over 12% ROE over the cycle. And we continue to seek and this mainly on two fronts. First of all, through the further implementation of performance improvement actions. This year, the focus is very much in indirect costs, that is materials and services, in process issues, and those actions are ongoing in many of our markets at this moment. And second, through the implementation of our renewed and very focused must-win battles and strategy, which I believe that the battles are very much designed to drive value creation going forward. Regarding finally our cash flow, in the first quarter of 15, the group's cash flow from operations was 2.5 million versus 8.1 last year. In this quarter, we had a one-off negative effect from a change in net working capital. However, I want to really state that we expect that to fully reverse back during the course of this year. For the reason that the market situation has improved, at least to a certain extent in certain countries, even much more than in some others, fleet investments are now completed somewhat more upfront in the year than in 2014. So looking at our gross capital expenditure in the first quarter, the gross capex amounted to 41.5 million versus 27.3 last year, which includes 8.5 million for acquisitions, the cash flow effect of which was 5.1 million. So because of the bit more of investments and the acquisitions and the one-off negative change in the net working capital, the group's cash flow after investments was 27.8 million negative versus 10.7 million negative last year. But when I look for the full of this year and going forward, I expect strong cash flow, but particularly in the second half and towards the end of the year in our expectations. I will close here and hand now back to Vesa, who will continue with the business segment results.
Okay, next I would like to have short highlights of each business segment, starting from Finland. On the sales side, we increased the sales by 5.8%, despite the still continuing weak market situation. Small impact is coming from our recent acquisition of Vuokrapekat. As we have disclosed, that company used to have a yearly sales level around 4.8 million euros. And that is the aim with that acquisition is to strengthen us in the capital area and in so-called dust control services. generally in the construction, their rental market is tough at the moment in Finland, but in other type of industries and in renovation, we have a somewhat better market situation, and that is somewhat, of course, supporting also our, let's say, aim to defend our margins in their weak market situation. And actually, that was one reason for defending good profitability, because I think this is still in the first quarter EBITDA to 12.1%. It's quite reasonable level of margin. On the other hand, modular space business continued to have a strong performance, and we have also very good order backlog for modular space. Here I want to remind that, as we have also reported in many quarters, so why we have been able to keep Finnish profitability on a, let's say, reasonable level is that we have implemented all our performance improvement actions first actually in Finland already starting a couple of years back. We expect that the rental market situation will remain challenging, at least during the first half of the year. And then hopefully the second half of the year will show some improvement already in the construction, which then could somewhat then bring more growth for rental as well. Highlight Sweden. Of course, having 12.2% growth in local currencies, that is very good achievement in Q1. It reflects good market situation, which started actually end of last year. As we recall, we were expecting the good growth starting already earlier. It started quite late last year, and it is clearly continuing now. This means that all their construction sectors are quite well growing. Of course, residential is the sector which is having the strongest growth. This means that also we achieved very clear profitability improvement when our EBITDA was now 12.2, giving a EBITDA percentage margin 16.5%. So strong performance. And we expect that this good market situation will continue. We have now a strong position in the Stockholm area, and also south is improving. North we see also somewhat improving. So we expect now that we have a good continuation, but at this early stage, of course, it's better to say that this is a promising start now. Of course, we have mentioned now already a couple of times that we have made last year our homework, which means that our cost is now on a lower level than earlier and under good control. That is also having, of course, a good impact also here in Sweden. Then we go to Norway. This is a somewhat tougher market. Our sales was actually decreasing, which was expected. So in local currencies, the decrease was 4.1%. This is reflecting the overall weaker market situation in construction at the moment. I'm satisfied anyway that we were able to defend our margin here. So in spite of weak sales performance, we were able to make higher margin than last year. And this was our aim also when we made quite hard decisions last year by restructuring the company. And now that is clearly helping here. On the other hand, we are very cautious of the market development in Norway at the moment. I think that the realistic expectation is that there will not be construction growth, but we will continue to defend our margins with their actions made, and if necessary, we will then continue to increase the actions. In Denmark, this was a good quarter in long time. So sales increased by 9.3%. This was partly boosted by some investments made late last year, and this means that our utilizations were clearly improving in Denmark. Our EBITDA was 0.4 plus, which is a clear improvement from last year when we still made a clear loss in first quarter. And the background of this, of course, is the big restructuring earlier, which we have now continued to sharpen, to focus on certain equipment and segments of certain operations, and we will continue actually also to make certain streamlining of our organization structure here. For example, making certain savings on our head office, etc. So with this good start, we could expect that the Danish operation could continue much more positive trend than we used to have last year. Then we take Central Europe. Here the sales increase was 9.3%. Of course, having now very hard year backwards, sales is, let's say, good, that it's improving, but one could expect that now when we go towards the high season, so sales improvement target is still higher, because now when we made the investments during last year, and now the utilizations are improving, so of course now necessary is to see that this is now continuing, which we of course expect here. On the other hand, our profit was still clearly loss. Some improvement from last year, but now the improvement which we are expecting really is now expected during the next quarters, which are also the high season. So highest expectation is for third quarter. As we have disclosed earlier, we have during the last year implemented all our harmonized management systematics in place in Central Europe, and that will start now to support the business operations gradually. Modular space is a good operation for us. It's still a small part, but it is growing well. And I can report that we have also just lately got two major projects, new projects. One in Frankfurt, a big school project, where we are delivering 175 modules installed in 3 stores. And the other one, just a recent big order, is a daycare center in Edingen, having 41 modules in the project. So we look for further strength in the modular space as well in Central Europe. Eastern Europe sales increased in local currencies by 9.6%. We faced improving market situation clearly in Poland, Lithuania, and Czech and Slovakia. EBITDA was still minus, but it was improving from last year, so the trend is now good. and with their good outlook in certain countries, we expect that now we will start then make much better plus profits in coming quarters. For Trent, for Russia, we can comment that also so their operations were improving from last year, meaning that the loss was somewhat less than year on year or last year. Sales for Trent was 7.2 million, clear decrease from last year, 22.5%. But the operations have been very well on control. So in a very weak market situation, the operation has been now having a smaller loss, which means that our share is now minus 0.1 million euro, when last year we booked 0.4 million euros minus for Trent. Then this interesting table, this is similar to what we disclosed after Q4, giving now a specification of our financials separately for equipment rental and modular space. For equipment rental, as we see, sales was growing in local currencies 5.8%, reasonable good growth, but very high growth in modular space. We had a good growth on the rental of modules, but extra high growth in, so as we say, rental related services. Practically this means that we had during the quarter many installations or reinstallations. So moving and building their modular buildings. But anyway, this shows a very strong growth for modular space in the quarter. EBITDA was improving clearly in equipment rental, but here we see a slight decrease in modular space, and the explanation is exactly the same than for the extra high sales growth. So there was a bigger than normal share of rental related services which have lower margins. This is very normal in this type of business. And then finally on the EBITDA, so margin for equipment rental was clearly improving and slightly lower in modular space, but anyway normally very strong level of EBITDA, 30.5 million, 30.5 percentages. Then at the end, if we just summarize how we have planned now ongoing our actions. Of course, we have now a good start of the year. We are still cautious, so we continue the actions which we have initiated last year. Here is a summary. Central Europe, a crucial thing is now the sales ramp up. So continue now to ramp up the sales and the utilization rates of our investments made. We are not now increasing the fleet in Central Europe, but increasing the utilization, and also with our new prices also increasing the price levels. For Sweden, good performance, but of course some certain actions related with especially direct costs are continuing. And very much same for Denmark, good start, but there are still certain actions which we continue. And same goes for Norway, to defend our margin with their actions already initiated. When we commented that we have had now a good development and at the moment good control over our fixed cost base, here is the summary of the first quarter, which shows that now the total fixed cost decrease was 2.1 million euros. And this we will report going forward, and we hope that we can even in the growth situation we try to keep the costs under very good control. And as a reminder, background of all this is our 3 must-win battles, which we in practice now continue. Deliver Cramo story, 3 promises. We are always available, we are always in time, and we always fix our malfunctioning equipment in less than 4 hours. We drive in certain opcos still very heavily the use of our management systematics, and then I already commented how we are going to win the Central European market. Then finally, just few words about modular space. We are now looking for, on the other hand, organic growth, but then also inorganic growth. For organic growth side, our aim is to grow faster than the market in Nordics, which I think we have been now doing clearly. For the Central Europe, now we have already existing container-based business there. We have got good orders, so we have a good order backlog for that part, which we continue. But on the other hand, then we have also delivered a Nordic type of high-class standards for Germany, and that is also the potential to increase clearly in the future. Then we are actually having this business also already existing in Baltics, and that we should not forget. We are continuing also developing that part. And in organic growth part, we are looking for further acquisitions within modular space in the existing markets, and we have eyes open also for other markets. And then finally, what do we mean by these Adapteo modular buildings? If we say that we deliver a user experience comparable to permanent buildings, maybe this describes well the difference between ordinary side huts and side offices. So with Adapteo, we concentrate on accommodation, daycare, office space, and schools, and high-class buildings, which we are able to supply for these applications. So at the moment, our fleet is close to 18,000 units. So we are already very strong in this part of business, and the utilization rate is stable. It's close to 90%, which means that we are investing all the time in growth in this business. And that's what we expect to continue also. So with these words, just to summarize very shortly. So generally, European Central Bank's monetary stimulus is expected to have positive impact on the markets continuously. On the other hand, we still recognize the uncertainties. Those have not disappeared, and that's why we have still somewhat cautious view also on the markets. On the other hand, as I disclosed, the markets on the construction side seem to be now growing, and that is also reflected positively to rental markets. So with this view, of course, it's clear that we keep our guidance unchanged. Now, I think we could have your questions. Let's take first questions here in the audience, and hopefully we will have a lot of questions from the web as well. Who will start?
Johannes Grasberger, Nordea Markets. First of all, the Sweden result. Maybe just talk a bit through how much of the growth or local currency growth was basically coming from the module side, and how much would you say the dynamic pricing model had an impact on the business in the first quarter? Because you comment on that also in the report. Of course, I understand you can't talk actual numbers, but just maybe verbal discussion.
First, about the modules. Yes, modules had a good growth, but I would comment that for Sweden, the modular growth was quite on a normal level. So as we have disclosed earlier, that long-term growth has been close to 7%. Last year we made clearly higher growth. So maybe one can reflect from there what was the growth rate for modular space. So it was on a good level, and we expect that that will continue. Then for dynamic pricing, we cannot have just one figure how much that is impacting, but there are two components. One is that it is having some impact in the price level. Then we are talking about few percentage points in the longer term. But very important is that now we have a much better control, and we can much quicker react in the price changes, and that's what we are doing. We have already late last year adjusted prices in certain products and in certain areas, and that will finally have this impact in the price improvement. It's hard yet to comment anything about the percentages, but we will certainly, with this very high and strong market situation, we aim to have further price increases in Sweden.
Just a short comment further to that. So the main growth is coming from the equipment rental part. It is a market which is really in good shape now.
If the modular space in Sweden wasn't okay, let's say the growth wasn't that strong, where did the modular space actually grow then?
I would say it was very good also for Sweden. It was still on a higher level in Finland. As well as it's of course small, but it is growing in Germany as well.
Yeah, fair enough. Then just a quick one on depreciations and amortizations. What kind of level would you guide for this year? It seems like at least the depreciation level is a bit down in first quarter versus last year.
Yes, I think these are, on the depreciation probably somewhat higher than if you slightly higher, because we have now added a bit of fleet, so that will increase a bit on the depreciation side. In terms of amortization, you can multiply that 2.1 million by 4. That is no big changes from the few small bolt-on acquisitions which we done early this year.
So the depreciations will go up still in the coming quarters, or?
Could be slightly more than in the first quarter in the next quarters, yes.
Okay. And then still on the performance improvement actions, I mean, those were clearly completed last year, but are there new actions ongoing or planned, or?
We see this business that always you have somewhere certain actions, but I would say that no extra actions at the moment. Of course, Finnish market is now still weak, so we are implementing certain actions which actually will also have certain impact even in our headcount. So our headcount is somewhat decreasing. So, but no extra actions at the moment.
And then the final question on Central Europe. If I recall right, in the third quarter, the discussion was that the customers were actually investing in their own fleet instead of renting equipment from the rental companies. How do you see that situation now at the start of the year? Has that changed?
In principle, we don't have recognized any let's say change. Of course, we are also in Germany selling some equipment. So I think that the situation as a springtime is very normal at the moment. So our expectation is now that we don't face similar weakness in rental as we faced last year, end of Q2, beginning of Q3, because that was the time when we had really disappointments. This we, at least with this outlook, we don't expect.
Okay, thanks.
Next one. No further questions? No? Okay, let's take if there is someone on the web.
No questions from the web.
No questions.
All right.
Are you sure? Okay, tell me.
Tom Milmuni from Carnegie. Regarding Central Europe, is your ambition to deliver positive results for that business area this year? And then the second question regarding your operating margin target of 15%, when can we expect that to be achieved? Thank you.
We have 3-year plan, and that includes still next year and year after that. So it's too early to say exact when. We are very satisfied when we can follow the plan during this year, which means that then next quarters have to show clear improvement. It's too early to say when will that, but of course our final target is to have at least that level. But it's realistic to say that with this performance, of course, it takes certain time. But everything is now in place to continue the improvement.
And then Central Europe.
Central Europe. Sorry?
Yes.
Yeah.
So you were commenting on Central Europe.
Yes. Yes.
Then there was another question on the when we will reach 15%.
Sorry, I combined this. I thought that you were that when we will reach there. Okay, of course, this is also difficult to disclose now, but if the markets are continuing positive development, so it will be sooner than we expected, let's say end of last year. But we are still a little bit cautious, even though it looks now so promising. Okay. So that was all questions. All right. Thanks for your attention, and we continue then next time after Q2.
Thank you.
Thank you.